Alright, so I've been investing for the last 4.5 years of my life, and I feel that I'm finally hitting the point in my investing journey where I can confidently give a simple advice to anybody who may be starting. This is not going to be some sort of complex video. I'm just going to be simple, honest, and transparent with you, something you can't really find on finance YouTube these days. So if you appreciate that, all you gotta ask, hit the subscribe button. But before we get into the video topic, I'm curious to hear you guys watching the video right now. 1, how old are you? And 2, how long you've been investing. I'm genuinely curious to hear. It doesn't matter if you're a beginner or an experienced investor, you have to answer. But let's get into the video though regardless.
Hello, I like money.
So to start off, I want to talk about some of the common emotions and experiences that I had when I began my investing journey. I would consider this the first month to about 2 years of the investing journey. Then I think you kind of eventually reach a point. And this video is basically just to share that you don't need to have that kind of process in your investment journey and that you can, make it very simple. And that's just by investing in index funds in a few core businesses that you really understand. I'll get more in depth in that part of the video at the end on what I think is appropriate for a newer investor to start off by doing. But when I began investing, I was very loose in picking stocks. I didn't have a crazy criteria. I'd go off a lot of what I knew and brand recognition. This included investing in companies like Colgate because I used their products and I saw other people using their products. When in reality, Colgate's an ancient company with no growth ahead of it whatsoever. It's not going to go anywhere. It's going to preserve your money but not grow it to the maximum potential. For somebody who's 18 to 21 years old, you want to have your companies be growing consistently because when you have growing companies, your money will compound faster and you'll make more money at the end of the day, to put it as simple as that. But I was very loose in picking stocks. If I saw a company that had solid dividend yield and dividend growth, they were pretty much in my portfolio automatically. I was not picky or nearly as picky as where I'm at today. This has to be one of the most common things in newer investors too, is diversification. Now, when you start off watching dividend YouTube, you see people that are 45 years old with portfolios with about 30 to 50 holdings, which is absolutely insanely over diversified. Now, when you over diversify, a lot of things happen to your portfolio. 1, you're more likely to underperform. There's one takeaway if you're 18 to 21 and starting investing from this video. You need to be performing with the S&P 500 or at least somewhere near there. If you aren't beating the S&P 500 or keeping in line with it, then you're pretty much losing out on capital, obviously because of inflation. But when I started investing, I felt like it was a requirement to have at least 25 to 30 holdings to diversify my holdings. You could always be told this in those, common finance, beginner videos. You need to diversify your portfolio in case one stock goes down, you have another to go on to. But you shouldn't be picking businesses and companies that are going to have any chance of failure whatsoever. Now, obviously, any business can go bankrupt any time. That's kind of a given. But you should have businesses where that's very, very unlikely to happen. And even if it does happen, you maybe have 4, 5, 6 other holdings where you can rely on. Better yet, you just invest in the S&P 500 and you are literally historically guaranteed to have a return over the long term. Unless something certain happens. But still, there's no reason for you to be owning more than 20 separate businesses and stocks. Even right now in my portfolio, I think I'm over diversified. I have about 20 holdings right now. I'm trying to get it to around 15, which is a little on the higher side still. With all these different holdings, I have some companies that do really good this market and some companies that do really bad. And I underperform still on the long term because you own so many of those kind of companies, you're not going to win no matter what. Now, obviously, if you're nearing retirement, you're going to want to have some diversification in your portfolio, but there's no need for it. Historically speaking, if you're 18 to 21, to be having 30% of your portfolio in defensive stocks, another 20% in telecoms, it just doesn't make sense. Another thing that I also did was I took the partial owner role in a business a little too seriously. Now, when you're buying a stock, you're basically a partial owner of a business. You hear that phrase so much, but I took it a little seriously. This led to me getting emotionally attached to stocks when in reality, stocks are just numbers on a piece of paper. Now, honestly, this could just be my inner autism coming out, but I'm sure somebody else has a little bit of tism in them if you're watching this channel. I had a very hands-on approach to the portfolio too. I would constantly be researching stocks, and now as I've grown as a person, I have actual responsibilities now, money to make, women to see. Unfortunately, I can't always be doing deep dives and research on companies and businesses. As much as I love it, there's a chance that one day I may not love doing it. I want to have a more hands-off approach, which is why I've gone towards more index funds and just finding a few really quality businesses that I've been going heavy into. And lastly, this is definitely something every new investor feels, is being heavily impacted by other sentiment, positive or negative. Now, something that I admittedly have said repeatedly that I've done when I started investing on this channel is that I would go watch one stock analysis video where somebody gave a lot of upside and little downside. I'm not going to say names, but dividend data. There were some companies that I really lost out on and some companies that I got into. Well, Microsoft for being one of the really positive ones, Visa as well, but also a company like Intel where I didn't pay attention to any of the downside and I took advice off a YouTube video. And that's nobody's fault but myself. I shouldn't have been doing my research on companies off a YouTube video. But positive sentiment is one hell of a drug, and negative is too. You need to build your own thesis and sentiment around a business for a long-term time horizon and just come completely dialed on it. You need to look at a company's fundamentals, financials, balance sheet, and all that other good stuff and build a logical, reasonable thesis based off that. Here's how I am currently as an investor in some of the areas where I wish I would have started off as and what I would do if I began investing now. Now, I have a much more passive active approach. Now, what's a passive active approach? That sounds pretty stupid, Ryan. So essentially, a passive active approach is, you actively look at your stocks, evaluate them, have a good thesis on them still, but it's not like every day you do it. You need to do it like every quarter, every half year. But ideally, you should have businesses that you own for a long-term time horizon. You don't need to stress about owing. Of course, I did bury myself in a few companies and stocks right now that I'm trying to get out of, some burdens, you could say. But putting that money and the money that I put in those burdens and putting them into higher quality companies that I'm much more confident in that will have greater growth, better dividends, and better total return over the long term, I've been pouring my money into that and just letting them do their work. That is what I have been doing recently as an investor. I'm also basing my thesis off fundamentals, not emotions. Now, this led to me selling out of some stocks that unfortunately I had some emotional attachments to, and some companies that I may be selling out of soon that I have emotional attachments to, i.e. Target. It was pretty hard for me to sell out of some of my first ever stocks that I ever bought in the portfolio at some really good gains as well, because they're good businesses and I have an emotional attachment to them. They're the first ever stocks I've ever bought. But looking realistically, it was the smarter move to do. And even acknowledging that some companies that I've kind of hyped up on the channel have been kind of core staples of the channel, like Target, may not be in my portfolio for much longer. Now, obviously, with Target, I'm not selling out now, but at the right price, I'm definitely going to. It's not one of those forever businesses where I feel maybe a company like Microsoft or Visa may be. And don't worry, I'm not moving on from Starbucks anytime soon, but once again, if something fundamentally changes with them, I won't hesitate to sell. I'm also learning not to overpay. Now, this is something I made a huge mistake with a company like Nike. Nike has such a strong brand where it's valued at a premium valuation with not a lot of growth behind it backing that valuation. Eventually, it would have to come down to fair price. Now, one would say when you begin investing, Nike is one of the strongest brands in the entire world. They're going to be around forever, right? Now, you don't really care about the valuation because your logic is that they're going to be around forever, and over the long term, you're going to get a really good return regardless. That is complete BS and fake news. You can overpay and lose money with any business in the entire world. It can be the best. Even a company like Costco right now. Another thing coming back to emotional investing is being a lot more pro-index fund / ETF. Now, when I began investing, I was not pro-index fund. You can go back and watch videos like that because I like that active approach of hand-selecting my own businesses. But now, kind of maturing as an investor in person, I've realized that it's much more better just to buy an index fund like the S&P 500 and just chill, because you're going to get a better total return and make more money no matter how much emotional output you put on the investment. And lastly, another very important thing, dividends are not free money. And I put dividends are free to kind of get your attention here. The day that I stopped looking at dividends is free money. My portfolio has improved so much since then. I'm going to get a much better total return and more money at the end of the day than I would have if I was chasing dividends. Dividends are a huge trap for a lot of investors. You should be looking at dividends as a supplement to your total return. Honestly, if I begin investing right now, I would find maybe, 4 or 5 really high quality companies in the entire world, do your due diligence, join the Discord link in the description, talk about them with other investors, bounce ideas off each other, and invest in those. And mainly just invest in the S&P 500. So honestly, that's what I would do if I were a new investor. Just buy the S&P 500 and chill. Maybe find a few companies you really like and do due diligence there and research. But don't go really heavy. Don't get too deep into the rabbit hole because of individual stock picking, because you will lose money. I guarantee it from experience and others. Thank you guys for watching. Smash the like button, subscribe, and do dividend stocks, not drugs. Have a good one.